Hi, everybody. Welcome to another 21st Capital show. Today, we have the privilege of hosting Pierre Rochard, who is one of the well known personalities in the Bitcoin space and has done tremendous contributions over the years, both intellectually and practically in the industry. So, hi, Pierre. How are you?
Hey, very well. How are you?
Very good. So, I think you and I connected a few months back when you announced your plans to get involved with Bitcoin bonds and like further corporate developments around Bitcoin. And so I thought that's very interesting and novel, and wanted to hear your thoughts. And the scheduling didn't work for a while, and so I'm glad that we can finally discuss it and hear from you directly what you observe in the industry, what your plans are, and what opportunities you see, and get some insider take on all this.
Yeah, absolutely. Happy to. So, yeah, it's been a busy summer. Sorry we couldn't do this sooner. So basically, when I look at where the current landscape is in TradFi, obviously your audience is probably familiar with where things are at with Bitcoin. In TradFi, after Dodd-Frank happened, it really reduced the amount of risk taking going on in the commercial banking system, and they had good reasons for that after the financial crisis and the risks posed by just fractional reserve banking in general. They wanted to reduce or increase reduce leverage ratios, increase reserves, and tighten underwriting standards for the commercial banking system. It had, I think, two kind of perverse effects. One is what we saw with SVB, where they had issues that were unrelated to credit quality. It was actually, treasuries that they were holding that they had duration mismatching, and that was still an issue. So I don't know that they solved the underlying problem, which is kind of a maturity mismatch between demand deposits and term loans on the asset side. But the other side effect it had, I think, was actually very positive, which is that it moved a lot of lending to what is today called private credit. And in the world of private credit, you actually have much better maturity matching between the institutional investors, the LPs in these funds that are committing capital for multi-year periods, and then the lending that happens to small and medium-sized businesses that is on that same kind of duration. And so that's been very positive. I think it's also been very positive because it really moves a lot of the capital flows out of the political process of being dominated by, the FDIC. And as we saw with Operation Choke Point 2.0, that you don't want to mix the credit system and the political system, right? So much. And so let's talk about how Bitcoin fits into that, right? Which is that these private credit funds, they have a mandate to go lend out against assets, against businesses, future cash flows. They can't go and buy a commodity like Bitcoin. So even if you're operating a private credit fund and you are bullish on Bitcoin, you can't even go buy the ETF. It's just outside of your mandate. And so I think that there's a huge gap there where they need to have products that are powered by Bitcoin that can pass through a due diligence and investment committee process. And so, that's what we want to develop with the Bitcoin Bond Company, is products for them. Now, concretely, what that looks like is that you put Bitcoin into an SPV, and just in the same way that you would put mortgages in an SPV, and then you issue notes against that asset, just like you would with mortgage-backed securities. And then you have those notes be tranched up so that you have senior, mezz, junior, and you have the ability to transfer risk and reward through subordination, so that the junior tranche, the equity-like leverage long Bitcoin, the senior tranche, less downside risk, less upside potential, and that you're really just reallocating Bitcoin's risk reward from kind of this spot USD BTC commodity to a set of notes that are going to appeal to different investor appetites. Because if you have a credit fund that is more aggressive on Bitcoin than another one, they're going to want to have a way to express that view. And that ultimately, what I think is really important about this, even if you're a Bitcoiner and you don't have a mandate constraint, you're going out and you're buying Bitcoin, is that if you look at a lot of who are the investors in private credit funds, who are the LPs? It's institutions, and it can be things like teachers' retirements, right? And ideally, all those teachers, yes, they would have a hardware wallet and they would be stacking sats for their retirement. Realistically, I'm just observing empirically that's not happening. It's happening for a very small percentage of teachers, or for any other number of end beneficiaries who are saving through the pension system. A lot of these pensions are underfunded, and so what they need is Bitcoin, right? And so what they need is vehicles to actually be able to access Bitcoin and to meet their mandates, to help people retire, or in the case of insurance companies, right, to meet insurance claims. And so there's all sorts of good end uses to it that I think that, for Bitcoiners, it's like, well, we don't like TradFi, and we want all these industries to disappear. But the question is, what do you do in the meantime? Do you make people not be able to retire because their fiat assets went to zero in Bitcoin terms, or do you actually help them? And so I think that we got to figure out ways that fix the money, fix the world. We've got to figure out how to get the money into everybody's hands, whether they like it or not, right? And that's especially, we see that the S&P 500 decided to not include MSTR, which I think would have very quickly gotten lots of financial exposure to a wide set of people, because if we end up with Bitcoin adoption only happening to who is risk seeking enough, right, who's young enough to take on the volatility of spot Bitcoin, combined with who is tech savvy enough to hold their own keys, then we would just create a massive wealth inequality in society as hyper Bitcoinization happens. So that's kind of the underlying thesis for the Bitcoin Bond Company.
Yeah, so basically the core friction you're trying to solve is there is institutional money with demand to allocate to something that actually outperforms inflation, and it has a reliable high performance, and so they can't allocate to actual Bitcoin, obviously. And so let's look at the demand side first. How pervasive is that mandate limitation? Are there still like a minority that have access and they can still buy, say, ETFs, or is it like the absolute vast majority of the institutional money is limited in their ability to buy Bitcoin?
Yeah, so private credit funds are between $1 and $2 trillion today. So if we just look at that, in a vacuum, then that's a large number. And then, of course, adjacent to that, you have all these different fixed income portfolio managers, for example, right, where they can't even invest in preferred stock, right? So when Saylor describes his offerings as fixed income securities, I agree with him. Economically, they are fixed income securities, but they don't have a maturity. They're preferred equity. They go into equity portfolio managers bucket, and then those equity portfolio managers outperform their peers over on the fixed income side. Their peers on the fixed income side are not going to let that happen without making some moves over there as well. And so they need to have vehicles that have a maturity, that are in the form of notes, that have a stated yield on them, and that they're going to be able to invest in.
All right. And then conversion of, so Bitcoin itself doesn't have a yield, obviously, right? So what are the strategies to convert that price appreciation into a more predictable yield in a way that doesn't cause problems? Because with yield, you have a fixed promise, right? And then with Bitcoin, you have everything except lack of predictability, at least in the short term.
Yeah. So that's exactly it, which is that the vehicle doesn't have any cash outflows for 5 years. And so all of the interest accrues so that you sell all of the Bitcoin after 5 years, and you send the proceeds down the cash flow waterfall. And so that way you have a way of having the yield without having any cash outflows. And so I think that, that's the way to convert those capital gains into a principal and interest product. Then after the principal and interest are paid, then there's a profit share of participation. So the junior tranche gets the most participation, and then the senior tranche gets the least. And so that's how you're able to make sure that the economics are a win for everyone.
Wow, that sounds very exciting. So do you also have to make some price assumptions for that?
Yeah. So basically, this changes every day, right? But around today, so if we looked at where do we need the Bitcoin price to be in 2031, let's say, for this to be for the vehicle to work for everyone, Bitcoin price would basically have to double over the next 5 years. So it would have to be north of $250,000, let's say, in 2031. And so anything short of that, then the junior tranche is going to earn less yield than they expected. And then eventually they're taking a haircut. And then eventually the mezz tranche is taking a haircut as well. And if Bitcoin goes down, 80%, and if Bitcoin goes to $20,000 in 2031, then the principal of the senior tranche would be at risk and would be getting a haircut.
Okay. Yeah, I mean, it's pretty reasonable to assume Bitcoin goes up. The very least, we have money supply expansion, and Bitcoin is going to be the strongest sponge to absorb that. But yeah, it's important to run those analyses and see what happens. So it is possible that you'll have a bubble, and then by the time an investor wants to, or your 5 years are up, we have a particular issue, and Bitcoin comes back to 20% above today.
Yeah.
And
so that's my main
mediocre performance at that.
Yeah, that's my main day-to-day focus is all of the backtesting. And so if you look at Bitcoin's 5-year CAGR, 97% of the time it's been above 20%. And so the vehicle would have worked 97% of the time. The real exception is if we had originated this in December of 2017 at $20,000, and then you fast forward 5 years, December of 22 at $17,000. And so that's where you would have really, the only part of the vehicle that would have performed would be the senior tranche. And then the two others would have suffered losses. And so I think that part of it is discipline in underwriting, right? So thinking about where are we in the cycle? You don't have to time the top exactly, right? But you kind of have to have a sense of when are things overheated, from a historical perspective versus closer to fair value.
Now, how does this compare to buying the ETF? So my guess is there's no free lunch, right? So if you're getting more predictability on the yield, you're probably losing quite a bit on the upside, right? Is that the compromise?
Yeah, that's right. Yeah.
Okay. Yeah, makes sense. And so I'm trying to compare this with what MicroStrategy is doing, because we don't have any more comparison, right? It's probably
it doesn't exist yet. Yeah. So, I mean, I think that's my interest is finding kind of greenfield opportunities where I think that there needs to be something that exists. It just so happens that I have a background in securitization, so I understand kind of that mindset. I hope that there's competition. I hope others do it as well. I think that there's massive room for building these products, but there's not really anything to compare it to for now. Eventually, I hope there will be.
Yeah, I think this is a very strong idea. I think even stronger than some of the examples or ideas that are in the field, because it's basically an upside or appreciation sharing engineering approach that doesn't promise what may not be there. So you're basically, if it appreciates, everybody benefits from that. If it doesn't, then the risk has to be distributed. So a lot more bulletproof than, say, borrowing a lot of money, which will then can potentially create risks of solvency and so on. So
yeah,
and you're solving a real problem in the industry.
So within the vehicle, you can think of it as the junior tranche borrowing from the senior tranche, right? What I think, and actually, there's a very similar product called structured notes, but the difference is that the counterparty is a financial institution, and so you're leaning on their credit rating, and it's basically a derivative, right? And so, from my perspective, having let's call it the physical Bitcoin, right? At a custodian in cold storage in a legally, bankruptcy remote isolated SPV means that you're not taking the credit risk of the Bitcoin bond company or of any other financial institution. It really is as close as you could get to lending to the Bitcoin network, in a sense, is one way to frame it. And that I think that then we're going to do this potentially, on repeat. So on a quarterly basis, launch a new SPV so that the risk is compartmentalized. So if one of them blows up because, Bitcoin crashes at, year 5, it doesn't affect the other ones that were originated under different circumstances and have a later maturity date. And so I think it's really important to kind of compartmentalize that risk and give investors the opportunity to decide what do they think is attractive in terms of market timing, or to dollar cost average, basically, and to develop a blended risk return exposure.
Yeah. So some of these quarterly vehicles could have technically a situation where you have obligations that the price doesn't support, right? So that could be a adverse scenario, but I know exactly what you're doing on a daily basis. Those back testings, I've been doing a lot of them this year, and so looking at a variety of scenarios. I wonder if you're using particular price model. Sailor has one. We at 21st Capital have our own quantile model. A few other folks have different models to at least build a base case, but then of course you can create a variety of scenarios yourself. High volatility, low volatility. How are you thinking about that?
I just look at the entire price history. I think I have a feed that goes back to 2010, and that's my data set. And I think that's the most defensible, because you could argue that, hey, look, there was a structural change, 2 years ago. All of that, all the historical price information is less relevant today than it was back then. But if I'm looking at downside, I'd rather look at what the worst case scenarios, which I think are the historical ones. And that going forward, I would argue that there's a lower probability of worst case scenarios going forward than there was in the past. And so I'm not looking at past returns to look at upside, right? That is not interesting to credit investors. They're looking at what's the worst case scenario. And then if the CAGR is 40% or 60% or 80%, that's not really that doesn't move the needle from an underwriting perspective. It's really about is the CAGR going to be negative, or how close is it going to be the cost of capital, right? To this stated yield that we have on the V.
Exactly. Can you deliver the yield or not?
Yeah.
Whatever the rest of it is
icing on the cake.
Yeah. And so you will have this combination of there is like a promised yield, and then there is some sharing of the upside, and you said probably on the downside as well, right?
Well, on the downside, it's mechanical. Of you start by taking away from the junior tranche, and then you take away from the mezz tranche, and then you take away from the senior tranche. And so it really is about, for the senior, the way that the senior, I think, should think about it is that they're underwriting the existential risk of Bitcoin. They're basically arguing Bitcoin's going to continue to exist. They're not doing moon math, and so that's talking about decentralization, no single points of failure. Is Bitcoin at least going to go sideways over the next 5 years? And so I think that's a very conservative conversation to have, and I think that's appropriate for the senior tranche. For the junior tranche, that's where they really are thinking about what's the upside going to be. And so if they're doing moon math, they want to go leverage long and have stable funding, right? Not have liquidation risk in the next 5 years. That's very attractive for them to say, hey, look, this would actually outperform spot Bitcoin if we're that bullish. And then the mezz is really more in between, of kind of really closer to the senior in the sense that they'll never outperform Bitcoin either. But they are getting a higher stated yield, and so they are kind of further out on the risk curve.
Very nice, very nice. So how's the process of once you're happy with the analysis and that's there? How's the process looking? Because I've been looking at the process in different countries, and in some cases they've been very easy if you have the right connections, and in other cases I'm guessing the United States would be a long process of approvals and applications. How does that look like? How long would it take?
Yeah, so it's really, to your point, it is about personal networks, right? And I'm blessed to know people on both sides of the industry, right? On the Bitcoin side and on the Tradfi side. And so it really is about working with underwriters, large investment banks, working with credit rating agencies to see what potential ratings could happen. And then doing a private placement, a 144A. That's not, it's not a public offering, so it's very streamlined in that sense. And eventually, I think that the way the industry as a whole will evolve will be that these will be SEC, listed instruments that do trade on a secondary market, just like mortgage-backed securities got there eventually. If you look at the history of BlackRock, for example, it's a history built on top of mortgage-backed securities and the development of that market. And so I think that eventually it could have a thriving secondary market of Bitcoin-backed credit. And that's what's going to help a lot of these credit investors who today are kind of stuck underperforming inflation with higher risk, right? They're underwriting high PE ratios, kind of middling private equity type transactions where we also are seeing headlines that a lot of them are struggling to give cash back to investors, that they lent it out for 5 years and then the company can't really put up the cash after 5 years, and they start doing rolling it forward and having extensions. And so I think it's a challenging market out there for the credit world, and they need a form of collateral that I would argue today Bitcoin is the most under-levered asset base in the world. There's very little credit underwritten against Bitcoin, as a $2 trillion asset class. And so I think that it's just ripe for massive growth over the next 20 years.
So you could actually be this magnet for unused Bitcoin, if for lack of a better term, for big piles of Bitcoin to access the fixed income.
Yeah. So today, like the average Bitcoin is held for 2 years, and I want to make that longer, and have like Saylor wants to make that infinitely long, right? So he's like, never sell your Bitcoin, right? I have it's a slightly less ambitious goal of, hey, let's stretch it out to 5 years, 6 years, eventually maybe 10 years, right? Bitcoin's only 16 years old, so I think it makes sense to start with 5. I think 3 years would also work. I've done some back testing on 3 years. I think that would be fine as well. But when we look at the world of lending, lenders want to, yes, they want to get their cash back, but they also want to put their money to work, right? And so they don't want to get it back too soon. They don't want to get it back too late. And so it's a kind of striking a balance there. Now, what in terms of like giving Bitcoins a home, we've seen as Bitcoin hit $100,000, it seems like there was a lot of OGs who maybe they bought at $1 and they're rebalancing, right? And
good psychological range, yeah.
Yeah, they made life-changing money, so they're making life-changing moves, and they're spending those Bitcoin. And so I think that we do have to find a way to essentially match up supply and demand, right? And to get Bitcoin into a new set of strong hands that are long-term investors.
So I think you partially addressed this, but I was gonna ask, what would be the ways for people to get involved? And since it's private, so then it's a completely different condition. But what do you think of it? What do you think of the final model, maybe in 5 years or something, once it's fully grown? And how would regular Bitcoiners or investors be able to use these products?
I don't think they would be able to be honest. I think that if they end up using them, it's indirectly, right? Where they're being forced to contribute to a pension fund. That pension fund invests in a private credit fund. That private credit fund invests in a vehicle like this. And so I think that if you're not mandate constrained in that kind of scenario, then there's lots of other great products. I mean, I think that the perpetual preferreds are really, from a retail perspective, pretty interesting in the sense of saying, well, if I have a dollar liability in 6 months, right? I've got a tax payment. I've got I've got to pay for kids' school or any kind of vacation or something like that. If you put that money into Bitcoin, the problem is that you're going to have to sell those Bitcoin, and you could potentially sell it at a loss, right? And so when you're thinking about your 6 month or 12-month emergency fiat reserve for fiat liabilities, then I think it makes sense to try to find what's the highest yielding fiat asset. And today, on a risk-adjusted basis, it seems like that could be the preferreds that Strategy has issued, and that they're completely mispriced from a risk perspective, is what I would argue. When I model how over-collateralized they are, and I think it's just and then if you were to ask me, well, why are they mispriced? Why, because markets are efficient, right? So what's the alpha here? I think it's because historically preferred equity has been a terrible investment. And so there's lots of hesitance towards going for that. And also that there's a lot of people who think, Bitcoin's going to go to zero. And so they wouldn't buy the preferred, because if Bitcoin goes to zero, those preferreds would go to zero as well. And then also they're just very young, right? So if you think about the world of investments, it takes a very long time for new products to develop traction and to get to the correct price that they're going to be at in the long term. And so these preferreds have only been in the market for 9 months. It's less than a year. I would argue that we're not going to see efficient pricing for them until in 10 years when it's just obvious, right? And so I think that that's the real opportunity for retail investors who need short-term cash. Comparing, because really you're not comparing it to Bitcoin. What you're comparing it is to a money market fund, to a savings account at the bank that's yielding 0% or 3%, right? And so that's where where I would direct that kind of attention to. And then you also have people who it's not that they have a short-term cash liability. They might be thinking long-term, but their problem is that they have a chart bias. So I know some people in my life who I've explained how Bitcoin works to them. I explained, hey, I think it's going to go up over time. And then they look at the chart and they say, I'm going to wait for it to go down. No,
already up. So if it doesn't go up, they're going to say, oh, it hasn't done much. It's down, actually. If it goes up, are you going to buy at the top? So let's wait for it to come back down.
Yeah. And even if it's not a top, they might think it's a top, right? Because they're looking at the chart and they're comparing it to the chart of ExxonMobil, right? It's like, so they think it's in a bubble. And then they never see the lower prices that they were waiting for ever again. Or Bitcoin's price is going down and it's a bear market and they're like, no, Bitcoin's dead. Like, you didn't know what you were talking about, and they don't buy. And so I think that there's a lot of people who, and we've heard this for years, they say Bitcoin's too volatile for them. And I think the Bitcoiner response is, no, it's not Bitcoin that's volatile, it's the dollar, right? And that Bitcoin's very stable, and you have to look past the exchange rate. I think that can work for some folks, right? That might flip a switch in their heads. For others, they're like, you're an idiot. Of course it's volatile, right? Look at the price chart. If you had $1,000 in Bitcoin on day one, and then Bitcoin goes down 90%, now you've got, $100 in Bitcoin. Obviously, it's got a volatile purchasing power. Usually what they mean, though, is that it's too volatile to be a currency. So they'll say, like, how are you going to buy your apples? You go pick out your apples, you get to the cash register, the price has already changed. I think that's kind of a silly objection. But the greater objection, I think, is from an investment perspective. And so if you have a vehicle that has less volatility, that can be attractive to them. And that, they're bullish on Bitcoin. They think Bitcoin's going to do better than 10% a year, right? So they don't think that there's long-term risk on the preferreds. And they might also actually be in a situation where there's career risk. So imagine an equity portfolio manager that can either buy the Bitcoin ETF, IBIT, or they can buy STRC or STRK or STRD or STRF, right? And they're thinking about their performance evaluation in 6 or 12 months, right? Where they're going to have a conversation about their portfolio. Well, maybe it makes sense to go with the less risky, lower upside of a preferred instead of spot Bitcoin with an ETF, right? And so, and you could judge them and say, hey, look, like, you should put your beliefs ahead of your career. You should take that career risk, or you accept that, like, they're actually going to be in a position to be able to hold, right? Because one of the problems is that you get to your performance evaluation and they're like, hey, look, Bitcoin's down 5%. You got to cut that position. And then they sell. Like, that, it's pro-cyclical. It doesn't help anyone. And then Bitcoin rips up 80% the next quarter. And, their beneficiaries, right? The people who were investing with them are now worse off. Whereas if they were able to hold a position in a preferred because, it's up 3% or 8% or, 10% or whatever it is, then not only are they going to be able to, benefit over the long term, but also that they've indirectly bought Bitcoin, right? Because Saylor went out and bought Bitcoin using the proceeds from that preferred. And
so you're pursuing securitization mostly in collaboration with Strive, or is it
Oh, no, completely unrelated. So the Bitcoin Bond Company is my startup, my baby, my passion, and I love working on it. Strive is a new Bitcoin treasury company, and I had a very long conversation with the whole team there to understand kind of what their approach is, and they offered me a board position as an independent board member, and to be the chairman of their audit committee. And it was a huge honor to say yes to that opportunity, because I think that, when we're looking at the Bitcoin treasury company space, there's going to be, my primary thesis is that there's not enough Bitcoin treasury companies. There's going to be hundreds or thousands more of these companies launched over the next decades. And that really, when we think about the business model, I think this is year zero. You could say year zero is 2020 when Saylor first bought his first $500 million, but his intent was not to go tap the ATM, to accretively acquire Bitcoin by issuing more securities, to do convertible notes and all, and the preferreds, obviously. And so I actually think that the preferreds are the definition of a Bitcoin treasury company is that they issue preferreds, is kind of my mindset at this point, because that's what has intelligent leverage because of the fixed income nature of them. And you have duration matching between holding the Bitcoin forever and the perpetual preferred, being perpetual, right? So the principal never comes due. And so I think that, I'm excited to be joining the board at Strive. And we just announced that, we've got a $750 million pipe. And so that's kind of the beginning capital base. Then there's an additional $750 million in warrants that come with that pipe transaction. So potentially up to a $1.5 billion capital base of just pure equity, right? And that's what we're coming out of the gate with. And then a $450 million ATM on the common stock to, get pretty close to $2 billion of an asset base. And then plans to potentially offer and issue a preferred in the future to start intelligently leveraging up that balance sheet.
Interesting. So I'm curious to see what your thoughts are about the treasury company or in general securitization models for Bitcoin, because I think sometimes I teach innovation concepts, and there we often discuss Gartner's hype cycle. It is basically how innovations emerge and go through, different psychological reactions from the market. Generally, what happens is you have an idea that has merit, sometimes a little bit maybe ahead of its time. And so it starts there, nobody cares about it, and suddenly it passes a threshold. Everybody realizes the potential. Now people jump to it, so it starts an exponential growth, and so you get into a bubble situation where expectations are now way ahead, and so people just don't realize how much time it takes for this technology to actually lead to something. Arguably, probably the AI situation is right now like that. So then once that happens, you get through a phase of sort of, coming to grips with reality, or kind of tempering expectations. And so that rapid proliferation of options turns into gets into a consolidation phase where people have to kind of look at it in a more realistic way. And then the demand for that comes to a more sustainable level and then keeps going on from there. So you initially have to go through this painful process of bubblish market, and then allowing the actual sustainable strong ideas to remain. Do you think we kind of had a similar process this year, or because a lot of the expectations have been not realized? I think people were kind of a lot of investors, because we publish research for general Bitcoin investors, and so we do observe sentiment is really down. A lot of people have been allocated to these equities or names, and they have underperformed, especially compared to the expectations. It was supposed to outperform this year, depending on where you were, underperformed a lot. Volatility is down. And so I wonder what you think about what's the reason, because Bitcoin is really not down that much, right?
Yep.
And so this could be just basically, people just got ahead of themselves, right? And then market has to get to balance, or maybe there's some macro factor that's that kind of slowing down progress, and it's gonna come back again and reignite excitement. Just want to know what's your perspective on this.
Yeah. So first on the Gartner hype cycle, I think that we're going to see it happen repeatedly. And so over the coming decades, there's going to be several full hype cycles for Bitcoin treasury companies. Arguably, it's what's been happening with Bitcoin, right? Of having repeated, it's like a fractal, right? It keeps zooming out. Now, in terms of this year, I think that because it's so new, there's a few different parts to it that have been problematic and that are learning opportunities for folks. One is that we saw the development of like meme stock investing, like GameStop and AMC and that kind of activity, where I'm old school. I'm like Benjamin Graham, intelligent investor, fundamental value analysis. You open up a spreadsheet, you go to the SEC filings, you comb through all of the different moving parts, you develop a valuation model, you compare your valuation to the trading price, the market price, and then you kind of come to a determination of, is it at fair value? Is it overvalued? Is it undervalued? What are the prospects going forward? And it's a kind of a bottoms up investing approach. And that to me is like, that's what investing is in my mind. Like the word investor is in my mind somebody who does that.
You'd be surprised. Today at lunch I was thinking, you only qualify as an investor if you're doing an analysis. If you just drop your money into a broad fund, is that really investing? Just pure coincidence. Sorry for interrupting.
Today it's like it's interesting. It's almost like on the retail side, that's seen as like complete overkill, right? You should just go on Robinhood, look at the chart, and just FOMO in, right? Like, look, maybe that can work. You're watching Wall Street Bets on the Reddit, and you're seeing a ticker symbol, and you just jump on it, and you ride the momentum, and then you exit. It's like, I don't like that very much. I don't like that approach. I think that you get a lot of you're not attributing your performance correctly, right? Suddenly you think that you're a great investor because you had one ticker that did well, and you've got a hot hand, and you've got gambler's fallacy basically, and then you up the ante, right? You start putting on margin lending and doing options trading, and you think that you're a genius hedge fund, but really what happened was very factor specific. You don't have a repeatable process. So I think that we've seen a lot of that happen with Bitcoin treasury companies as well, unfortunately. And so I think that it's, for all the listeners out there, I honestly would argue that if you're not willing to do the work of fundamental analysis, you should just buy Bitcoin, right? Do fundamental analysis on Bitcoin for sure. But if you're not willing to do it for securities, I don't think that you should be involved necessarily, right? And that's kind of the promise of Bitcoin, is saying like, you don't have to do securities analysis anymore, right? You can just hold sound money. And you should only do securities analysis if it's a passion of yours, you're interested in it. And you want to use that as an edge to make money, I suppose, right? Or to outperform Bitcoin. But if you don't do it and then you underperform Bitcoin, I don't really think you have room to say that, oh, it's the fault of the Bitcoin treasury companies that made me buy at an unreasonable valuation, and that's kind of there's an element of responsibility and self-sovereignty, right? You have control over the buy button. Nobody else is making that decision for you. So that's one. Two, I think that there's a lot of misunderstanding about kind of the mechanics of capital markets, right? So people expect that if MSTR is levered long Bitcoin and Bitcoin goes up 4%, then MSTR should go up 6%, right? On the daily candle. And I think that confuses what, would be really a levered long ETF, right? And those exist, right? There's levered long ETFs that promise you that on the daily candle. And then on the monthly or on the annual, you've got decay, right? And so I would argue Bitcoin treasury companies are the opposite. On the daily, you're not going to see that relationship, generally speaking. There might be some days where, you can kind of glean into it, but generally speaking, it's not going to have that mechanical relationship. And then on the long term, that's where you would expect to start to see that relationship if the company is performing, right? If they're doing the intelligent leverage and Bitcoin is outperforming their fiat liabilities in the form of preferreds or of the convertible note. And so and they've had accretive purchases of Bitcoin from issuing common stock at MNAV greater than 1. So there's all these different levers. And so I think that's kind of the second reason why the sentiment might be that, like, hey, Bitcoin's going sideways. Why are these companies going down? Now, the third element is really more idiosyncratic of specific tickers, right? Of specific companies, right? Because MSTR did not do a PIPE investment, right? So why did they not do a private investment in public equity? Well, because from a regulatory perspective, they don't need to. They can actually go and have very sizable common stock ATMs and sell stock directly into the public markets and be able to raise billions of dollars to go buy Bitcoin. The new Bitcoin treasury companies that launched this year through reverse mergers or through SPACs, from a regulatory perspective, they actually cannot go out and directly to the public sell 200% of their existing, share count. And you could argue that there's good reasons for that regulation to be in place, right? They don't want, the SEC and the exchanges don't want issuers to just, engage in heavy dilution, even though I think in the case of Bitcoin treasury companies, we have to keep in mind, what are they doing with the proceeds? If they're just buying Bitcoin and they're doing it accretively, then even though it's, diluting the share count, I don't think it's diluting the enterprise value. And so I think that it's actually accretive for the shareholders to do that. And so I wish that regulation didn't exist in this particular case, but it does, right? And so when they're the new treasury companies are kind of bootstrapping their balance sheet to achieve a level of scale to where they're going to be able to put on intelligent leverage on competitive terms, then the PIPE is actually the appropriate vehicle to do that with, the right tool in the toolbox. Then what happens around the PIPE? Well, they make a public announcement, right? And the only way for retail investors to be able to participate at that point is to go buy the target of the reverse merger, which is generally a very small cap, micro cap company that has a very small float, right? And so, you're talking in like basically the 1 to tens of millions of dollars. And you have this outsized level of attention from the retail audience of, oh, I'm going to go buy that ticker symbol because I want to participate in the new Bitcoin treasury companies. And so ideally, that cohort of retail investors would do their fundamental analysis and realize that, the structurally, maybe the equity might be undervalued, maybe it's overvalued, but that they need to come to that decision not based on tweets or press releases, but based on fundamental securities analysis. Okay, then you layer on top of that, you might have hedge funds that are short sellers who will look, and they've done fundamental analysis, and they've come to the conclusion that the rational thing to do is to put on a short. And, they might be right or they might be wrong. I'm not like prejudging what their decision is. And then add on top of that, retail investors who see the short interest in that ticker symbol and decide that they want to engage in a short squeeze and to pile into this thinly traded illiquid security in order to trigger a short squeeze to, further drive up the stock, which again, they're not doing fundamental analysis. They're really looking at technicals and, the short interest and all this. And so I don't like any of the activity going on, right? So I don't like short sellers either. It's just my first principles, like let's be optimists. But they're rational actors, right? They're obviously institutional investors that have a mandate to find opportunities that are overvalued, that are potentially overvalued, because they could also be wrong, right? And so you could imagine a scenario where they're engaging in this activity and Bitcoin suddenly doubles or triples, and the momentum on the Bitcoin treasury company is such that their short actually does not work out, and they do get short squeezed. And then so they are taking risk. I think everyone in the equation is taking risk. But then when the pipe shares unlock and the supply comes onto the market and the price goes down, as we saw with Naka on Monday, well, in that scenario, the first wave of retail buyers, they're regretting their decision to have bought at too high of a price. Hindsight 2020. The short sellers are profiting off of the situation. They're going to have to cover at some point, so maybe that's something to look forward to. And then the ones that were trying to cause the short squeeze, right? Those retail traders, they're outraged that they did not get their short squeeze, and that the opposite happened, right? And so I think that there's a lot of participants in this where then everyone who was long wants to blame the Bitcoin treasury company, or even they want to blame the entire thesis behind a Bitcoin treasury company, right, behind the whole industry, because they were not kind of looking at these dynamics through a sober lens, and they were trying to play a game of musical chairs in some cases, rather than, again, doing the fundamental securities analysis to understand what they want to do with their capital. And so I think ultimately lots of lessons learned, right, by all the different market participants. Hopefully going forward, the pipes have essentially accomplished the strategic goal for the company, which is to be able to capitalize the company rapidly and to be able then to have a common stock ATM that is bringing shares directly to the public rather than through a pipe process. And so, I expect that everyone in the markets should be able to should already know what I've just described, and that none of this is a surprise to them. And if they didn't know that, then I think that they should have probably just,
yeah. And I would say, and I'd say we have a shortage of analysis, like a strong, deep analysis, not just analysis plus marketing or like high level promotional discussion. A real fundamental analysis, like you mentioned, about how to value these companies, especially with the new ideas that Bitcoin is introducing. It has changed the game. So perhaps it needs a whole new framework to be able to, first off, you're not dealing with a cash flow generating business. Like, you have to understand how appreciation works, because there's no way to value Bitcoin like in a traditional sense, right? Generally, financial analysts like to work on cash flow, work it backwards to figure out present value. But with Bitcoin, the dynamics that causes its appreciation is generally supply demand balance. So very difficult to kind of pinpoint where it might go. Uncertainty is much higher. And so the valuation analysis is different. And a lot of people that have been trying to use like pretty old models, they would say, okay, this thing has no value. Nassim Taleb or other ones, they use math, which is very elaborate and everything, but it's based on wrong assumptions. So that's one part of it. And then in these understanding Bitcoin and its fundamentals, itself is, I love this quote that it says, Bitcoin is everything you don't know about computers plus everything you don't know about money, right? So it becomes a foreign subject to many traditional financial analysts, let alone the regular public. And so then you're wrapping it in an equity model or some sort of security, which introduces a wild range of other factors. So for example, with MicroStrategy, you know how much Bitcoin they have, what's the market cap, but there are different products in there, different layers, the capital structure. So actually, to figure out what is the exact amount of Bitcoin that's you're entitled to is a lot of work. So, and we don't have, as far as I've seen, we don't have good kind of research products or analyses that people could leverage and to be able to differentiate these. First off, understand how to think and value these new companies, these new equities. And so in that environment, what that happens is most people have to, figure it out themselves, look for, a few experts here and there, listen to them. And a lot of the people, as an observer of the Bitcoin market for near a decade, I've been seeing this with many people. And I see the same pattern with these equity buyers, where people simply gravitate towards outsourcing their thinking to some other authority. And so that can go well if you're a good learner, but in some cases it also leads to a situation where you have people that are naturally bullish because they've made a lot of money, they had a lot of good decisions so far. And so naturally they keep being bullish, but as a new investor with little knowledge, you're most likely to hear this right at the top, because that's when the power of the messaging is the strongest, and most people hear about it. So generally, as we get close to the top, that's when everybody hears, oh, this thing has gone 10x, right? So they come in and then they keep following the crowd, which is the worst thing you can do in financial markets. Because if you're following the crowd, especially if you're early, it's great. But if you're following them after the fact, you're pretty much close to where it's really late. And even if you're investing in a really strong long-term fundamental trend, there are cases where it enters mini bubbles. There are cases where it enters extreme valuation zones, and the way to determine that is where the crowd is going. So if you go against them, that would be the best situation. So I actually do strive to, no pun intended, to figure out, read more about the frameworks, or maybe some leading analysts that are able to really discern and separate the strong versus weak Bitcoin equity options. So let us know if you know you have any thoughts on that, or maybe how would you yourself make that determination?
Yeah. So, if we look at the equity markets today, I think that the reason why they're more efficient than what we're describing here is because there's so much institutional grade research happening, right? So behind the scenes, right, you've got lots of very well paid people with both quantitative and qualitative analytical skills working together to develop a view on what securities prices should be and competing against each other on that in the marketplace. And so the price signal is very information rich compared to what we've been discussing today. One hope could be that first of all, as the industry grows, there'll be more institutional involvement. And so just earlier this week, I think, or late last week, there was a Wall Street Journal article about Capital Group, which is a very large institutional asset manager that is very active in the Bitcoin treasury space and has been buying, securities from Strategy. I think they've also bought shares of MetaPlanet. And so they're the only one that I know of that, is sizable like that, where based on the Wall Street Journal article, it seems like the portfolio manager there is also a value investor, right? So he's using those same kinds of frameworks of determining the difference between the market price and the real value of the company, given some set of assumptions. Maybe what helps democratize value investment, because otherwise you've got to basically, if I go through my academic career is a bachelor and master in financial accounting with lots of finance coursework, as part of that. And so to me, it really is, it starts with the debits and credits of the income statement of cash flows, balance sheet, and reading through the SEC filings, understanding the supply and demand dynamics for the shares in the market as well, right? As we were talking about with the price. So all of this, how to get somebody who's busy and doesn't have time to do it. Well, first of all, I'd ask them to just not be involved. I would ask them to just go buy Bitcoin and put it in cold storage. And that, that's the first part. If they really insist, at the very least, go on ChatGPT 5 Pro, turn on the research mode, and prompt it, hey, look at this company's SEC filings, identify any red flags, identify whether the next 5 years are going to be good for the company or bad for the company, and outsource your thinking to, if you're going to outsource your thinking to something that is more objective, rational, and hopefully intelligent than the loudest people on Twitter, right? And so that might be something that's new today, right? Of using AI to give you maybe something that's even higher quality than you would get from the average financial advisor, right? Or even from Morningstar or investment banks, putting having research coverage on a name and putting out, buy or sell recommendations. So that gives me some hope that people will be able to leverage AIs as each generation gets better, that they then, will at least be better off than just what Robinhood has, even if it's not the same as having a team of 4 people coming through financial statements and putting together a model and stress testing it, and then doing relative value, right, of looking at all of the Bitcoin treasury companies, establishing comparability, establishing what metrics matter, right? Does MNAV matter or not? All these different questions that people argue about on podcasts and on Twitter. These are serious financial decisions if you're relying on them. And so I generally, it's kind of like, when somebody goes to a store and they're like, oh, how much does this cost? And the response is, if you have to ask, it's probably not for you. That I think is kind of the situation that we're in, given the lack of even, just institutional coverage, right? So very few of the Wall Street investment banks are covering very few of the names because they're so early. It's almost like you're doing, you basically, it's more like investing, right? Like these companies are early stage ventures, and that's the lens to look at them through. Of it's a high volatility baseline, right, of Bitcoin, combined with a high volatility of the Bitcoin treasury strategy, combined with the high volatility of early stage. These companies are less than 1 year old. And so
it's basically everything you don't know about money, everything you don't know about computers, everything you don't know about securitization and early startups. So
yeah.
it's a 4-dimensional problem.
Yeah. And, the counter argument would be, well, that's the opportunity, right? That for those who are really serious about digging into these and then identifying, times to go long, times to go short. I've heard of new hedge funds popping up that are going to be focused on Bitcoin treasury companies. And ultimately, I think that we do need that kind of capital in the space to drive more efficient pricing going forward.
Yeah, like you said, for most of the time, what has kept Bitcoin available for investors like us to benefit from is the obscurity. So if it was easy to understand what's going on, then opportunity would have been gone already. So this is could actually be, like you said, an opportunity for people who put in the work and the effort and they look at it in the right way and they actually use their brain and maybe ChatGPT to analyze and find real value, as opposed to chasing things. So awesome. I really appreciate your time today. I've learned a lot. Definitely wishing you the best of luck moving forward, and looking forward to hear more about you and more about your thoughts about the industry. Any final points or comments?
No, you can follow me on X at Bitcoin Pierre. If anybody has questions, of course, my DMs are open, or you can just, send a tweet. Really appreciate you taking the time to ask some really thoughtful questions, and looking forward to coming back on someday as things unfold.
Awesome. Fantastic. Thanks again. Thank you everyone for watching, and we'll see you in our next episode.